South African investment managers have been increasingly nervous to get exposure to retailers. That's on the basis they're too expensive. Now, Mr. Price alone has a greater market value than all 6 of South Africa's construction companies. At the same time, resource stocks have been sold down to multi-year lows. Joining us from our Cape Town studio to discuss the disparities, Abdul Davids, Head of Research at Kagiso Asset Management. Abdul, thanks so much. So, just looking at the numbers, we've got industrials which were up by 10.5% for quarter 3. You've got financials up 6.5%, and then resources lagging 2.9% gain. Everyone's saying it's foreigners that continue to buy our retailers. Are they seeing something we don't? Because when it comes to local asset managers, everyone's refusing to get in there, but it seems that foreigners continue to buy at these hefty premiums. How do you explain that?
Well, we can't. Thank you very much. Unfortunately, what we have seen is that what we typically look at is stuff like earnings yield, PE ratios, for example, and they're at multi-decade highs for a lot of the retail stocks. And clearly, what we also look at is the differential in ratings between retail stocks and, say, for example, miners or platinum miners, to be more specific. And that's also at multi-decade highs as well. What we do, however, admit is that the retailers have been fantastic in growing earnings over the last 5 to 10 years. And clearly that is being rewarded not only by the foreigners, but domestic fund managers as well.
Abdul, we just had one of your peers on the show, Patrice Rousseau from SIM, and we were talking about the unsecured lending market. What's your take on the amount of retail sales that we're seeing from unsecured lending, and is it sustainable in your opinion?
Again, this is something that we have been flagging for a number of quarters now at Kagiso Asset Management, because we can see a clear link between retail sales and the massive build-up in unsecured debt in South Africa. Clearly, we know that retail sales has to be a subset of GDP and GDP growth, but clearly where retail sales, as has happened in the mid-1990s and post the 94 elections, where that grows at the multiple of GDP growth, clearly you have extraordinary factors that drive that. And in the case of South Africa at the moment, it is a build-up of debt that we're seeing. Because people are not getting the wage increases and haven't been getting the wage increases that is commensurate with retail sales growth, the mismatch and the gap has to be funded by debt. And we have seen the growth and the explosion in unsecured debt in South Africa. And that is making us very jittery at the moment, and it's something that we believe is unsustainable in South Africa.
So, Abdul, how does this type of view shape your investment philosophy right now? Because if you look at the Kagiso Equity Alpha Fund, which in fact has been the top performing domestic general equity fund since it started in April 2004, what type of investment philosophy are you following right now in light of the rally we've seen for retailers?
Yeah. That's a very good question, because we always find it difficult to box ourselves in a box, because people always want to box you as either a value investor or a growth investor, etc. I think what we do is, and we stick to our knitting, is really focus on valuations. And those valuations are derived from what we call discounted cash flows. And clearly where we see opportunities is in stocks where either the ratings that people are paying for those cash flows are very low or declining. And similarly, where cash flows due to short-term sort of pressures, like in the platinum space, are under pressure, but we see them rebounding to normalized levels in the future. And as a result, we see discounted cash flow valuations much higher than current market values or spot prices, for example. And that's particularly where we find opportunities and value. And on the other hand, we would avoid those sectors where we see DCFs and discounted cash flows being under pressure in the future, but they are flying high at the moment, like the retail space we see currently.
Abdul, one of the areas that you've identified as offering value is obviously the resource counters at this point, and I wanted to find out if you would be one of those people in favour of seeing Mick Davis take over the role of Cynthia Carroll. Is that something you'd consider as an investment house?
And of course, Abdul, keep it in mind, just looking at that, that stock, you've got 3.8% of your that equity fund sitting with Anglo American right now.
We are aware of that. I think that is a very personal sort of decision, and it's obviously something for the Anglo's board to decide. However, what we want to register is our disappointment with Anglo's management over the last couple of years. I think Cynthia in particular has been in charge of Anglo's for exactly 5 years now. And it's really disconcerting to see the current sort of rhetoric that's coming out of the Anglo stable. Both in terms of the inability to deal with the platinum, which used to be one of their big and star performing assets, and the rationalization that is clearly needed in that asset. And then also some of the poor decision making that we've seen recently in terms of the offshore projects, most notably the Ministrio. We know that costs and capital budgets has really blown out significantly over the last number of months as well.
So Abdul, apart from perhaps a drastic management change, what type of decision making needs to be taken right now? Where do you see management go? As you say, you pointed out the mistakes they've made, but where do you see potential for them to rectify the problems that they are experiencing right now?
I think we also have to put on record that Anglo's has fantastic assets. If you look at their platinum assets, it's by far the dominant sort of tier one asset in the world. The diamonds assets in De Beers are unparalleled on a global basis. Even a company like Kumba is tier one, very low cost in terms of its iron ore as well. So clearly in terms of its asset base, it has a fantastic asset base and diverse portfolio. The problem is cost management, and especially costs at the head office level. And those are actually things that management should actually get a handle over, because they are not driven by commodity prices exclusively. Albeit that they operate in South Africa, where we know that the environment is quite challenging. But I think there's a lot that they can do in terms of rationalizing costs, both locally and in some of the international operations. They will actually return profitability much sooner for their shareholders as well.
Abdul, one of the big companies in your portfolio at the moment is Mondi, and I've seen this popping up a number of times in portfolios of local investment managers. What's the investment case for Mondi at this point?
Very good question. Mondi has had a fantastic sort of run over the last 2 years. Even year to date, it's one of the best performing stocks. But we believe that even currently, if you look at the business model, it's fairly protected. If you contrast Mondi, especially to Sappi, Sappi is not as integrated as Mondi is. And secondly, I think if you look at the markets that Mondi operates in, they're fairly protected. Eastern European markets, fairly defensive in terms of their uncoated fine paper operations. Even their packaging operations, craft paper, etc., the bags business, they're fairly defensive in nature, but they're also growing reasonably well as well. In addition, they've made certain acquisitions recently, most notably the Nordina acquisition, which we think is actually quite a fantastic business. It's quite niche, but also quite exciting. And potentially it has the whole of China as a potential market for its products as well.
And of course, Lonmin, if you're talking about the platinum sector and the mining sector, Lonmin makes the top 5 when it comes to equity holdings. So why are you still committed to the company right now? Because Quib's now recently talking to me and saying that of the platinum miners, Lonmin is looking most vulnerable right now.
We hear that, and I think what we have seen is that a lot of investors, unfortunately, have taken a very short-term view of the platinum space. Bearing in mind that overall platinum demand is still growing at between 2 and 3% on a structural basis. It will probably continue to grow as we see structural changes in automotive legislation coming out of Europe, coming out of the States, for example. So we think that the market is still there for platinum in the long term. And then secondly, we see that South Africa dominates global supply. And then in the case of Lonmin in particular, we have seen some of the negative fallout from the Marikana disaster. But I think what we have also seen is that if you look at Lonmin's balance sheet, their total debt is only about 3 billion rand, just over 3 billion, depending on where the currency is. They've got a book value of about 20 billion rand. So you're looking at gearing levels of about 15%. Whilst we admit that some of their debt covenants are clearly onerous and they'll probably breach that, we don't see the negative sort of massive rights issues that a lot of sell-side analysts, for example, are seeing and want to see in Lonmin. Secondly, I think if you look at the operational performance of the company, they're actually doing reasonably well. I mean, they're probably on track to produce more than 600,000 ounces this year, and of a market value of about 14 billion rand. To contrast that, Impala recently, their board has approved a capital project for Leeucop of about 10 billion rand for 145,000 ounces. So almost 4.5 times Lonmin's, or 4.5 times less than Lonmin's sort of output. And Lonmin's market cap is 14 billion, and Impala is willing to spend 10 billion on a similar project.